How to pay off a 30-year mortgage in 5 to 7 years. When you were younger, you probably came up with a list of things that you wanted to achieve by the time you reach a specific age. I'm pretty sure that one of those things is to own a house for yourself or for your family, because being able to do so can give you a peace of mind of not having to worry about where you will stay once you retire. Isn't that right? Part of building up this dream is, of course, considering the responsibilities that come with it, including paying your monthly mortgage. House mortgages are usually good to pay off for 30 years, which is a very long-term commitment. Imagine not being able to enjoy all the money that you work for at the age of 50 because you're still paying off your house. Yep, that sounds like a lot to handle. Paying off your mortgage for 30 years can be a lot of burdens. The good thing is that there are a lot of tips and techniques on how you can shorten the number of years in paying off your mortgage. It may sound impossible, but you can actually do it. 30 years? You can shorten that to roughly 5 to 7 years. How is that possible? For today's video, we'll be talking about techniques on how to pay off a 30-year mortgage in 5 to 7 years. Before we continue with the rest of this video, please remember to click the subscribe and thumbs up buttons as well as the bell notification icon. This way, you'll be the first to know whenever we release new exciting videos. Also, we'd love to hear from you, so please leave a comment in the comment section below. Make sure you watch the entire video, as we will mention a free way for you to win a $150 Amazon gift card. Okay, so let's continue with our video. First of all, let's talk about why it's a good idea to pay off your mortgage earlier than the original 30-year contract. If you recall from our last video, we talked about 10 reasons why paying off your mortgage can give you a lot of benefits. Not only when it comes to strengthening your house's equity, but in terms of improving cash flow and your overall net worth. Apart from that, getting a mortgage paid off early might save you tens of thousands of dollars in interest payments in return. How does mortgage work? Mortgage payments are a carefully calculated mixture of interest and principal amounts. Whenever you send out your monthly payment for your house's mortgage to the lender, the payment is split between principal and interest. A considerable amount of that payment is then put to interest early on in the loan. As time passes, a larger portion of the payment is applied to the principal. This is known as amortization, and it helps the lender to recuperate a bigger amount of their investments in the first few years. As we mentioned, dealing with debt for 3 decades is a lot of burdens to handle. So if you have the capability of lowering that to 5 to 7 years, then that's one less thing to worry about. But before you make this decision, make sure to ask yourself these 3 questions. First, is there enough money in my emergency fund to cover at least 6 months' worth of expenses? Remember that you will need to make a lot of adjustments to pay off your mortgage. But don't ever sacrifice your emergency funds. If you think that doing this can possibly affect your emergency funds, then this might not be the perfect time to do it yet. The next thing that you want to ask yourself is if your savings for retirement and other big financial objectives are on track. Last but not the least, make sure to consider any high-interest debt such as credit cards, and if so, how much? If your answer to all these questions is yes, then you're on the right track. Let's go down to the list of the 5 most effective methods for paying off your mortgage faster. Number 1. Make space in your budget. You may think that this first on the list is pretty obvious and simple, and you may even find it not so helpful, but that's not the case. The truth is, making room for an extra $20 from your monthly budget and adding it to your mortgage can help you a lot in terms of shortening the number of years to pay it off. Let's say your house is set to a $250,000 30-year fixed-rate mortgage with a 5% annual percentage rate, and you still have 25 years remaining to pay off the loan. Essentially, you would owe more or less $1,400 per month with this setup. Now, if you can consider adding $20 extra to each payment, you'd be able to save yourself more than $5,000 in interest by cutting the payback time by 8 long months. If you want a more detailed explanation, you can also use a mortgage calculator. You'd probably have to sacrifice a nice cup of coffee or a couple of takeout meals every week to achieve this, but you gotta look at the bigger picture to keep yourself motivated. The more money you put toward extra payments, the more savings you'll get in the long run. Number 2. Refinance to a shorter-term agreement. Most of the time, mortgage borrowers choose a longer repayment period to keep monthly payments low, typically 30 years. But throughout the years of working, you may eventually find yourself more capable of freeing up more cash flow. When that happens, one smart move is to think about refinancing your loan to a shorter term. The monthly payments will almost certainly increase if the loan period is compressed into a shorter time frame. But if you qualify for a lower interest rate, this is an effective strategy to pay off your mortgage much sooner and save a lot of money on interest. Number 3. Consider recasting your mortgage. Most people are familiar with refinancing, but not with recasting. One thing that differentiates recasting from refinancing is that you get to keep your existing loan. A mortgage recast, also known as reamortization, is a method of lowering your monthly payment. In a nutshell, what happens is that you make a one-time lump sum payment against the principal balance of your loan. As a result, your lender would change your repayment schedule. Doing so would automatically adjust your monthly mortgage without changing the conditions or interest rate of your existing loan. Number 4. Schedule extra payments. Not everyone is comfortable with adding an extra $20 to their monthly payments, and that's perfectly fine. What you can probably consider instead is to schedule a few extra payments spread out over the year. Let's say you got your annual bonus at work or maybe a tax refund. You can apply $1,200 each year to the identical mortgage to the example that we mentioned above, and you'd be able to reduce the length of your loan by almost 3 years and save over $25,000 in interests. If you plan to do this, the key is to make sure to verify with your lender to see if the additional cash will be applied to the loan principal. Because if you don't designate how these payments should be applied, the lender will most likely use them to pay off your mortgage's interests. Number 5. Pay on a bi-weekly setup. Last on our list is to consider splitting your monthly mortgage and paying it on a bi-weekly basis. By doing this, you won't have to pressure yourself by adding extra payments. If you calculate it, you would actually end up having one extra payment towards the end of the year. Although not all lenders consider this option, it wouldn't hurt to ask if it would help you shorten your loan's term. And there you have it. Whatever decision you make, be sure that you've considered all of your alternatives to ensure that you're getting the most value for your money. We hope you enjoyed this video. Again, don't forget to subscribe, like, click the notification bell, and leave us a comment below. We love to hear from you, and we'll be doing a random name drawing of the first unique 100 commenters who also like the video and subscribe to the channel. The lucky winner will get a $150 Amazon gift card, so get involved and don't be shy.